merger and acquisitions, first task will be to do a thorough check of that. A buyer's looking to buy an asset, price, maybe even negotiate better contract terms or warranties.
Hello and welcome to Dolfinergy, the podcast that explores the technical and strategic challenges shaping the energy and industrial sector. So when millions of euros are at stake, understanding the real condition of an energy asset becomes critical, and that's where technical due diligence, or TDD, comes in. So today we're discussing why TDD is essential, when it should be carried out, and how it supports major decisions in financing, refinancing, sales, or acquisitions. To talk about it, we are joined by Richard Musi, Renewable Energy Project Manager, who regularly supports our clients in conducting due diligence on energy assets in France and internationally. Hello, Richard, and great to have you with us.
Thanks, Nicolas, and great to be here.
So, Richard, to start, could you tell us a bit more about your background and your current role at Technical Advisory, subsidiary of the Dolphins Group?
Sure, thanks. Yeah, so throughout my career, I've had, the opportunity or the chance to work in the energy sector across several continents and through all phases of a project lifecycle. So I've only worked in the renewable energy sector for about 15 years now. So it's given me a holistic understanding of how projects evolve from development to all the way through to operations. So at 8.2 Advisory, so my role as project manager involves engaging with clients, understanding requirements, performing technical analysis, managing deliverables, and ensuring that the project is completed on time and within budget.
Okay, clear. So before we dive into specifics, let's set the stage. What exactly is technical due diligence, and why has it become such a crucial step in renewable energy projects?
Sure, so there are different types of due diligence carried out during a transaction. So, for example, legal due diligence, financial due diligence, and technical. So at 8.2 Advisory, we focus on the technical due diligence. So what is that? That's an independent and comprehensive assessment of a renewable energy project. So whether that's wind or solar or hybrid or battery storage. So the idea is to evaluate technical feasibility, look at performance, look at potential risks. So really what is the purpose? It provides assurance for investors, lenders, owners that a project is technically integral, sound, bankable, and sustainable, right? So during the technical due diligence, typical areas that we would look at are design, technology. So are we using kind of tier 1 modules, tier 1 inverters? Are the turbines, do they have a track record? Do they have after sales service? Things like that. Then there's things about permitting, environmental compliance, which is a really big topic, especially for projects in development. What's the chance of success? What's the potential probability that the project will get the permits in order to be built? Things like land lease, easement, can the project actually be built based on what they've secured in the leases? Will they be able to get access to the sites? Grid connection, contractual reviews, so EPC contracts, TSA, turbine supply agreements for wind farms, O&M contract, operation and maintenance contracts. Things like offtake contracts, so if that's contract for difference, CFD, PPA, power purchase agreement, or if it's from a regulatory commission. Things like financial model, studying existing yield assessments, and if it's an operational plan, then we look at the performance, the existing performance, and maybe costs as well, right? So it's quite a lot of stuff.
Yes, this is definitely a huge scope of work. So beyond the technical aspect, it's really a strategic decision-making tool, right?
Exactly, yeah. It shouldn't just be a tick box, and obviously the scope can be adapted based on the client, but generally that's the whole scope, and it's up to everything is flexible. So yeah.
Yeah. Okay. So so in what situations would this TDD be useful, and for whom?
Sure. So I mean, there's different contexts, right? Which I think there's two. I think we can say two main categories. So you've got M&A activities, so that's merger and acquisitions, and then the second category is financing. So if we start with the M&A activities, obviously we can either work on the buyer side or the seller side. So that means a buyer is looking to buy an asset or portfolio of assets, and obviously on the other side, the seller is looking to sell an asset or portfolio of assets. So on the buyer side, we would obviously be trying to support the acquisition by verifying are the assets integral technically, are there any hidden potential risks or future costs that might not have been identified. So basically we're trying to help the buyer validate the purchase, the price, maybe even negotiate better contract terms or warranties. But generally we're independent, but with a obviously with a mandate to help the buyer in their process. So that's the buyer side, and then on the seller side, so there's also, we can be on the other side, and that actually then is referred to as a vendor due diligence or VDD. So on the seller side, we're obviously then helping the seller to actually prepare the sale by in advance raising any potential red flags. So before the seller puts the assets or portfolio of assets onto the market, we'd help them to identify any potential issues so that then the seller can address them and, or provide documentation to help, reduce the risk of that. So what does that do? That helps to then obviously increase buyer confidence that the seller's prepared the sale, can obviously help to speed up the transaction and obviously improve the valuation, right? So yeah, it's different sides of the coin, and we can obviously work on either side. So that's the first category, that's the M&A, merger and acquisitions, and the second category is financing. So here we distinguish between financing and refinancing. So financing is basically that the developer wants to finance the construction of the project, and they need a lender, so either a bank or an investor, which can be a fund or a private individual, to provide financing or equity investment, right? So banks will look closely, or they will look generally to they will look to finance projects close to ready to build stage. Which is slightly less risky for them because early on in the development cycle, there's obviously less chance that the project would actually succeed. So generally RTDD or technical due diligence will be there to confirm that the project is technically sound, that the energy yields are reliable, estimates are reliable, and that basically would they get their money back if they lend money to this project, right? That's basically the question that the banks and the investors are going to be asking. And then a refinancing activity, which is slightly different, is that the project has already received financing, and then they're looking to refinance. Either they've got some revenue from the project, and they want to obtain better terms in the financing. So in this case, the lender would ask us to do an updated due diligence to assess, let's say, performance to date against original benchmarks, any extra costs that might be considered, what's the expected remaining lifetime on the project. So, it helps to ensure continued bankability, and, it supports the confidence in the lender of offering those new financial terms.
Okay, so I see TDD might be used and finally is required in a few transactions and a few situations where companies are positioning themselves on a portfolio of projects. But let's get practical. How does technical due diligence unfold, and what are the main steps?
Sure, yeah. So I think generally we can classify into 4 different phases or steps. So the first one generally is that we'll get access to a sort of data room, which is basically just a server or some online storage area where all project documents are stored. So obviously our first task will be to do a thorough check of that. What data's there? Are there any gaps in the data? It gives us a chance to raise initial questions about anything that's missing or anything that's unclear. So this is a really important step, because once you've started the process, you're setting expectations. So if the client says, is everything available? And you say yes, and then later you say no, that's obviously that's not good consistency. So it's important that we make sure that we flag any issues early so that the project can be on schedule. So in order to maintain a kind of good communication, we typically have a question and answer log, Q&A log, so that any questions that we have are written down and then can be responded to by the other party, so that we've got that traceability. So first thing is we'll have access to the data room. Then, second step, obviously, then we'd start drafting our report and doing the actual analysis, the due diligence. So we'll classify risks based on different color codes. Obviously different companies have their own systems, but we use a 5-stage color coding. So green basically is no issues, blue is something for information, yellow is a kind of minor sensitive issue that you need to have a look at, orange is a bit more of a major problem, and then a red would be a critical problem. So that would definitely need flagging, and actually then any red flags would immediately be raised to the client so that they can sort them, and that's regardless of buyer or seller side. Our analysis has to be as specific and as actionable as possible. So there's no point giving kind of unclear answers or something that isn't possible. So suggestions that aren't possible. So we're making sure that we give clear actions or measures to be put in place. And then kind of for early stage projects, if we're doing due diligence on early stage projects, we'll also include a sort of probability success criteria. So how likely is it that the project will actually reach ready to build or COD, based on things like, will they obtain permits, or what are the local environmental conditions like, or what are the local aviation constraints like, or generally what are the local opposition to that sort of thing. Obviously that's based on our experience. So once we've done the analysis, then we would obviously present the reports to the client. So we summarize the key findings, make sure that we present it so that nothing is misinterpreted. We do a meeting typically with the client, and that way they can immediately clarify any questions they've got. And then, there might be some follow-up activities, and that would be the last stage, which essentially would be that once we delivered the report, the client will need time to, look at the results and to potentially also see what the impact is on the transaction. And that might then lead to follow-up questions and follow-up Q&A, question and answer sessions to help us to address any other questions they've got, and to help them in any decisions that they make. So, basically the goal of our analysis is to give the client, whether that be a buyer or a seller, the information it needs to support their investment or financing decisions, or whichever it is, right?
Okay, so let me just sum it up. So it all starts by gathering all the data and deep diving into the risks, so that we can then present the client conclusions, and following up closely with the client throughout the Q&A sessions. So my question would be then on the right timing, and when should a TDD be carried out to be the most effective?
Sure. I guess it depends on context. So for merger and acquisitions, timing is typically dictated by the transaction itself. So if we're doing buyer side due diligence, the deadlines are generally very tight, because the seller will have put the portfolio out to tender, let's say, and the buyers will only have a short time to be able to put in their bids, and during that time they need to have had the due diligence done, etc., etc. So that generally leaves very short amount of time. So then we need to manage our resource and make sure that we're coordinated, and that kind of goes back to the previous point where we need to assess, the documents that are available and quickly and efficiently say, okay, yes, that's available, that's not clear, and be in close communication with the client. So for financing activities, so let's say that the developer wants to get financing to finance the construction of the project. So it's important to plan that activity in advance, but obviously not too early, because lenders, as we said earlier, they will be less likely to finance projects at very early stage, because obviously they're riskier. So also lenders and investors need time to complete their internal processes. So yeah, for financing activities, it's kind of an equilibrium. And then for refinancing, obviously it's just pure strategic objective. So, if the owner is not happy with their current financing conditions, then it's up to them, if they want to change those. So yeah, depends on their own internal strategy, really.
Yes, so I understand. It's crystal clear to me, but it leads to the point regarding trusts and relationship with clients and
Sure.
maintaining transparency, because as you mentioned, you can be defending interest of a buyer or a seller. So my question to you now is the following: are there differences in approach when performing due diligence on the buyer or seller side?
Yeah, so that's a key question in any sort of consulting world, right? And obviously you can't work on the buyer and the seller side at the same time, but it doesn't mean that you can't work on one side or the other, right? You can work on both sides, but not at the same time. So essentially on the buyer side, as we mentioned earlier, right, the focus will be on kind of leveraging points so that they can reduce the purchase price. That's clearly the aim of the buyer. Let's find all the small issues so that we can negotiate the price with the seller. That's clear. On the seller side, they've got the opposite thing. So they want to make sure that any pain points are minimized, and they want to make sure that the sale, the assets look perfect and they're performing perfectly, etc. So, our role is not to let's say color the picture so that it's rosier for a seller and it's darker for a buyer, right? So we basically have to stay as objective as possible. We're always in the same role, that we have to be objective, transparent, and factual. And I think that is true in any consulting world, right? It's critical to be impartial, and that's what helps to maintain business over time, right? Because that's what parties will be looking for. Buyers, sellers, lenders, advisor will be looking for someone that is impartial, because that's an independent, and let's say bankable analysis. Yeah.
Yeah, okay, I got it. So let me just now talk about more the insights and future outlook. Because to wrap up, I'd like to know, what advice would you give to an investor or project developer who's unsure about the value of a TDD?
Sure. Okay. Yeah. So why? Yeah. Basically, why do a TDD, right? So, for financing, refinancing, generally the banks or the investor will ensure that a TDD is included in the process of obtaining the financing, right? So the banks will impose that on the requester, and that they will request that the requester does an independent audit before releasing the funds, right? And basically that is giving the lender confidence that the project can perform as is expected and can repay the debt. That's basically the pure and simple reason, right? And then for M&A transactions, so a TDD provides insight into integrity of the asset, right? So it's as we said, for buyers it gives leverage, and for sellers it helps to approve the kind of sale price. So one example of a case that we had is that we were contacted by a client or potential client who said that they in the past hadn't done a due diligence, technical due diligence, before acquiring a ready-to-build project. So during or after the acquisition, and then when they were kind of going to the construction phase, they discovered that the cable to the main substation crossed underneath the railway line. So that then becomes an issue, because you can't move the railway line. To go under it requires a lot of people to approve it. So clearly it hadn't been seen because they hadn't done the due diligence, and therefore it wasn't included in the project's capex. So so basically it was a big oversight, right? That could have been avoided, and led to cost overrun, obviously project delays. So I think basically what I'm saying is that TDDs shouldn't just be a tick box, and hopefully they aren't. They should really add value. They should add value for the buyer to maybe help negotiate price, for the seller to justify it, or to avoid just technical issues on that could be avoided. So yeah, not a tick box, I'm gonna say, and ideally it should add value and minimize the risk to the parties involved.
Yeah, I guess the railway line example, feedback you got from a client emphasizes on the importance of TDDs being conducted to prevent any major risk while acquiring or developing projects. Thank you, Richard, for these fascinating discussions.
Thanks for your attention, Nicolas, and for the questions.
Yes. What we take away is that obviously technical due diligence is just not only an audit, it's a decision-making tool that ensures the value, reliability and sustainability of renewable energy projects. So thank you all for listening, and happy for you to learn more. Follow Dolfinergy on YouTube or Spotify for more content, and see you soon for another episode.
Thanks. Cheers.